Bloomberg Audio Studios.
Podcasts, radio, news.
After reducing interest rates by 25 basis points straight out of the gate in that news conference, asked an obvious question. Why do this when you're expecting inflation to remain above target? The chairman acknowledging today was a closer call, that we cut interest rates by 100 basis points across 3 meetings. The recalibration phase is over. We're in a new phase. Things are foggier, they're darker, you move more slowly. Well, this was the price reaction to that in the market. Equities slammed, down 1.5% on the S&P, on the Nasdaq down by more than 2. The small caps, some outperformance on the small caps going into the decision, real underperformance coming out of it. The small caps down by 2.8% in the bond market. Big move at the front end of the curve. Yields up across the curve, 2s, 10s and 30s on a 2-year, up by more than 10 to 434.82. And off the back of that, in foreign exchange, as you might expect, the dollar stronger against everything in G10, ripping up EM. Euro dollar breaking down through 104 and threatening to do the same to 103. Euro dollar right now at 103.64. We all had questions about the forecasts. Why have you bumped it up on inflation? Why are you projecting higher inflation than you were projecting back in September? Why have you reduced the number of interest rate cuts from 4 to 2 in the median dot for the dot plot in 2025? Is it about the data or is it about Donald Trump? Take a listen to the chairman of the Federal Reserve.
Some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecasts at this meeting, and said so in the meeting. Some people said they didn't do so, and some people didn't say whether they did or not. So we have people making a bunch of different approaches to that. But some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation.
Compare and contrast that to what you heard from the chairman back on November 7th. We don't guess, we don't assume, we don't speculate. December 18th, some of us guess, some of us assume, and Lisa, apparently, some of us speculate.
The we is doing a lot of heavy lifting at a time where clearly he's reflecting a splintering committee that is dealing with a whole host of different outcomes and potentially political leanings. And I just want to go here. This is going to be viewed through a political lens, inevitably. It already was threatening to do so. Now there are some people who are incorporating highly conditional estimates. I wish that we had learned more about what those estimates looked like and whether they all were inflationary or whether some of them were to slower growth.
Neil Dutta wanted to jump onto the program. We can bring him into the program right now. Neil Dutta of Renmac. Neil, is this Federal Reserve on a collision course with the incoming administration?
I mean, it certainly feels like they're tempting fate. Powell's talking about, he goes through a litany of indicators talking about how the labor markets are cooling. And then he, in the same sentence, basically talks about how they're dialing back rate cuts. So I think that's a problem. And, I think the optimistic take around this is by making the forecast adjustments that they've made, they're actually, in some respects, lowering the bar for additional action, early next year. Like 2.5% on core inflation. I mean, that's a reasonably high number. And, given what we know about rental inflation, that's probably going to slow down. Given what we know about, consumer goods, if you look at things like freight rates, it's probable that consumer durable goods prices moderate, over the next couple of months, just as the new administration's coming into office. So, I think they're signaling a pause, but it's also important to remember that by March, the forecast might look a little bit different, and they may have to cut again.
Neil, you were my economist of the year 2 years ago. You were optimistic when few were. Now you've switched, flat out switched. There's no other way to put it. How off is Atlanta GDP now at 3.1%? Does Powell know something we don't know, and those visible present numbers are just flat out wrong?
I never think, I don't think the Fed really has an economic forecasting edge of any meaningful degree. Tom, the Fed doesn't have a GDP mandate, so it's interesting to see how much Powell was talking up gross domestic product, private final, domestic sales. I thought that was pretty interesting, quite revealing, actually, because that was sort of a way for him to avoid the questions around the labor market. And we know that duration of unemployment, as an example, has gone up by 2 to 3 weeks over the last couple of months. Leaving that aside, I mean, you're right. I mean, I am more cautious. I remember 2 years ago, around this time, the consensus was conditioned for, basically everyone was penciling in recession. And all I did was point out the fact that the labor markets were fine and housing stocks were moving up and to the right. Fast forward to today, it's literally the opposite situation. Everyone is sanguine on growth. It's very difficult to talk about recession. No one really wants to hear it. And at the same time, we know that the labor markets are slowing by Powell's own admission. Okay, and just pull up a chart of home building stocks.
Well, meanwhile, Neil, I just want to point out the fact that other people are taking a different tack than you are. As you say, you're contrarian, thinking that there's more weakness in the market. Peter Scheer's saying this. He doesn't think it's necessarily political. He said this is a Fed that is worried that inflation isn't coming down fast enough. And while it might play in the back of their mind, they aren't responding to fiscal potential policy. On the margins, some are, but he's saying in general, they are not. Why do you disagree so fundamentally with that?
Just go through the document. Look at the balance of risk to the inflation forecast. It's a dramatic increase in the number of participants that see the risk to headline and core inflation as skewed to the upside. So, I mean, they can say whatever it is they want, but based on the data, it's very difficult to justify the distribution of risk that you see in the projections. And how are the risks to inflation going up at a time when labor is cooling and wages are slowing? We know that recruiting intensity is down. We know that quits rates have collapsed. Okay, that probably implies that there's further cooling with respect to compensation growth between now and the next couple of quarters. The dollar is surging today because of what just happened. You have to start thinking about what that might mean for the emerging market space, because obviously these countries have a lot of dollar-denominated debt, and that's going to imply tighter financial conditions in those economies. So, I mean, I think based on the data, it's really difficult to say that the distribution of risks have changed that much. And Powell even said that based on the inputs from core CPI and producer prices, you'll probably get a pretty weak reading on core PCE inflation when that data are released on Friday. And the big story, again, out of the inflation data over the last week has been the normalization of housing rental inflation. So I think, to me, this is it feels a little bit like they're prejudging potential policy outcomes.
EM currencies right now getting hammered. Neil, I don't expect a collar. I don't expect a tie, but maybe just a jacket next time. Neil, maybe a jacket? For some post-Fed show commentary.
I think it's okay.
Get me back in the studio. Get me back in the studio. I'll put on, my Gucci for you.
There we go. I'll make that happen, Neil. I'll make it happen soon. Hey, Neil, appreciate it, sir. Enjoy the holidays. Neil Dutta there.
You could have shown up in a Christmas sweater. I mean,
next time.
The white T-shirt was better.
I've got one with Roberta Baggio on the back.
Do you really?
Yeah, number 10.
Oh, but do you
nice
have
Christmas
like little things
sweater.
hanging off of it, like the little tassels?
No, not with jingle bells going on
and
it.
like lights.
It says
no lights, no glitter.
It says Monday. I mean, it says Monday.
Monday, definitely, when I'm not here. Sarah House of Wells Fargo joins us now for more. Sarah, these forecasts, some controversy around them. Neil Dutta making the argument that he believes that underpinning that shift in inflation higher, in those dots, for the dots coming down from 4 cuts to 2, he believes there's a real Trump effect in the forecast. Sarah, is it the data or is it the incoming president?
I think it's a little bit of both, John. So I think you've seen, certainly there's been a little bit stronger momentum in terms of the inflation numbers. That's why you got the upward revisions to the Q4 numbers here for this year. But I think when you look at just the magnitude of the change as well as the balance of risks, we heard Powell say that at least some participants included some assumptions around policy and some didn't say if they were. So I think there is a little bit of recentering the risks around the forecast within these projections.
Sarah, when you do all the math at Wells Fargo, as you do with Jay Bryson, when you sum it up, what are you going to watch forward to the next Fed meeting? I mean, Neil Dutta just said GDP is not part of the mandate. Do we watch the jobs report? Do we look at inflation? I mean, what really matters in the guesstimate forward into late January?
Yeah, it's jobs and inflation. So I think after today's meeting, it's a little bit more on inflation. So I think that's one of the big takeaways is we're seeing that emphasis shift back towards more of a focus on inflation after I think the labor market took more of the spotlight in the late summers. We had a couple-week jobs report, unemployment rate going up pretty quickly there. But I think today's message was they have less conviction about that downward path of inflation. So I think the next few reports, especially getting through the first quarter, where there's a lot of questions about residual seasonality. So do we actually see enough of a slowdown where you start to see that 12-month trend, which Powell talked about so much in today's press conference? Do you see that begin to come back down? But they are still looking at the labor market. And I think that did feature in not just today's cut, but also still what is an easing bias, where they do have a couple more rate cuts penciled in for next year because, as you heard Powell also talk about in the press conference, they're still seeing that labor market cool.
Right now, we're seeing markets respond pretty strongly to this, and people forecasting that maybe, at least this is the implication, this could potentially make a more difficult circumstance, particularly for smaller companies. From your vantage point, on the margins, if this is a Fed that sees itself in a dark room full of furniture or in a foggy land that's moving more slowly, that on the margins is going to slow your expectations, Sarah, for growth next year?
I think a little bit. I mean, we're still looking for 3 rate cuts next year, so not terribly different from what the Fed has penciled in. But of course, when they come, could have implications for what happens with financial conditions over the coming months. So I think when we look at the inflation picture, the rate picture, I think overall we're not seeing a meaningful dialing back of policy in the months ahead to the same extent that we were over the past 4 months, where you still have the real rates, closer to 1.5%. So not much change there. And I think that is still likely to be a headwind, particularly in some sectors like Neil was talking about home builders. So I think there's still certainly some pressure in some of those more rate sensitive sectors of the economy that are going to feel it a little bit more if the Fed's not going to be cutting quite as much or quite as fast as what they were thinking a few months ago.
The next 12 months is going to be quite a ride. Sarah, thank you. Appreciate your time. Sarah House of Wells Fargo. This is the Fed Decides, a Bloomberg Surveillance special live on Bloomberg TV and on Bloomberg Radio. If you are just joining us, a 25 basis point reduction from the Federal Reserve about an hour and 35 minutes ago, followed up by quite a news conference with the chairman, Jay Powell. Lots of questions about the forecast. They revised their forecast for inflation a bit higher for 2025 and beyond, and they took down their projection for interest rate reductions for next year, down from 4 in the median dot down to 2. Off the back of that, there were some questions about why cut interest rates at all. The chairman called it a close call, said the recalibration phase was behind us. We're in a new phase where we have to move more slowly. Off the back of that, equities just getting absolutely smoked right now. We're down by more than 2% on the S&P 500, down by close to 4 on the Russell 2000. Some severe, significant underperformance on the small caps. If you check out the bond market, we'll just take a quick slice of it. The 2-year, the yield higher at the front end by double digits. The 2-year yield pushing higher, up by around about 10 basis points on my screen at the moment. Call it 11 now to 435. Let's cross over to Mike Mathieu, who was in the room in the news conference. Mike, your big takeaway walking out of that room?
Well, a number of interesting things in the news conference, including the chairman talking about some members of the committee pricing in some possible effects from the new Trump administration fiscal policies. But the biggest takeaway that I had is that the Fed, including the chairman, are less confident. He wouldn't say he's not confident anymore, but they are less confident about the path of inflation. He basically said it's come down, so we think it's going to keep going down. But it's not like we were seeing in the summertime, where they were very convinced that inflation was on the right track and headed to 2%. So that's really going to inform their decisions as they go forward. The other thing that I take away from this, John, is interesting, is we need to rename this show, because you call it The Fed Decides, but I would add the words, the market disagrees. If you look at the forecasts now in the markets, there is only one cut fully priced in for next year. So we're going to have this tug-of-war back and forth between the markets and the Fed, it seems, ongoing from here.
That tension continues. Mike, appreciate your time, sir. Great work, as always. Joining us now is Jeff Rosenberg of BlackRock. Jeff, I want your first thoughts. I asked the question to Bob Michael at JP Morgan Asset Management, and I said to him going into the news conference, are you more or less confident embracing risk, given what you've just learned from the Federal Reserve? And Jeff, I want to ask that question of you. After that, are you more or less confident embracing risk into 2025?
Well, you can see, Jonathan, this is a surprise to markets. And so one of the things the markets had hoped for was a Fed that was very much leaning towards easy financial conditions, focusing more on the labor side than on the inflation side. And that was pretty supportive to financial conditions and taking risks. So you see the market reactions that you just talked about, not what markets were expecting. And so certainly that's a little bit less favorable environment for risk taking because you have a Fed that has really kind of surprised me. I think it surprised the market here in saying, hey, we're more worried or as worried about the inflation side now than we were about the labor markets. And that means we're not going to be as quick to cut. And it's the cut in the policy and the favoring of easy financial conditions that was so supportive to taking risk.
Jeff, the reviews are coming in. That was one of them. Here's some others. Steve Chivarone, worst Powell performance since 21. They overreacted to labor market data in September. Now they are overreacting to inflation data. Krishnamamani, probably the worst presser so far of his tenure, seems the support for this cut was quite spotty, but they went ahead with it anyway. Jeff, do you agree with that?
Yeah, a lot of the sentiments in there are about just how much the Fed, when they stopped forecasting and became data dependent, the problem is they're dependent on, as much as he said they're not trying to be, it feels like they're dependent on the last few data releases. And so, yes, going into September, it was all about labor markets. Now it seems it's all about inflation. I think one of the earlier guests said, and I would agree with this, this is not going to be a great forecast for where the Fed's future forecasts have been because they've been just so whipped around by short-term movements in data. And that certainly is kind of frustrating. And Jonathan, to your earlier question, it makes risk-taking a bit tougher because the Fed's signaling and what we're going to get out of the Fed is just that much more uncertain.
Jeff Rosenberg, Alan Meltzer at your Carnegie Mellon, Carl Brunner up at Rochester at a shadow open market committee, which the first rule was stability. I don't see stability in EM. I don't see stability. Granted, it's a different story in generic China 10-year. They're going to open here in 3 or 4 hours. Is BlackRock internationally concerned about the Asia opening here? Call it 7 p.m. our time?
Neil mentioned it in his comments about the impact. The Fed sets monetary policy based on domestic U.S. conditions, but the impact on the rest of the world is as important, particularly when it flows back into the United States. And how is the channel for that flowing back? It's through the potential of tightening of financial conditions. I think the tightening in financial conditions from the dollar increase is going to be much more front and center in emerging markets. What Powell talked about is the exceptionalism. What no one really talked about was what is the source of that exceptionalism? What is the source of that exceptionalism? Partly, it's this incredible technology, AI, wealth creation story that is feeding into positive animal spirits. It's feeding directly into consumption through the wealth effect. And so that creates a little bit of a buffer around the U.S. economy, around some of the blowback issues you raise in terms of currency opens and Asia. So I think, we keep an eye on it, but so far it's really this much bigger story about American exceptionalism, which has a kernel, a really important point of that about this incredible wealth creation we're seeing coming out of technology.
Jeff, I'm pleased that Tom brought this up. The move we're seeing on the screen, the foreign exchange screen on the Bloomberg terminal really lighting up. We've got a 3% move on the Brazilian currency year to date. We're talking about a move of 23% on the Brazilian currency, 21 on the Argentine peso. We're looking at something like 17% on the Mexican peso. Jeff, as I look around the world beyond EM, not just to Europe, but including Asia and China specifically, China's looking at a disinflationary bust potentially. The chart of the yields, government bond yields in China, just lower, and rolling over into year end. Jeff, how much divergence do you expect for the US versus the rest of the world in 25?
Yeah, we're really exiting. We talked about exiting the phase of monetary policy. We're also exiting this phase of kind of harmonized macroeconomic implications for inflation that was then feeding into harmonization for central bank policies. And so as kind of the reasons that Powell talked about for that decline in inflation without kicking up unemployment rate, it was really about the restoration of supply chains and the post-COVID impact. That was a global impact. That's now starting to dissipate. And what's coming in the aftermath of that are a lot more of the idiosyncratic country-specific fundamentals driving those economies' performance, the currency. You mentioned a bunch of different countries there, from Brazil to Argentina to China. That's really all about domestic economic policies, economic performance that is driving. And so that's really a market environment of divergences rather than convergences. And so that's really affecting the investment outlook, is particularly, for investing between the markets in what I call the cross-section. That's actually a better investment environment. It takes out kind of the directional call, is the dollar going up, is the dollar going down. And you have a lot more opportunities within that global cross-section of investing, both in currencies, FX, curves. It actually creates a better environment in some sense for alpha creation, because divergences create more alpha opportunity.
Jeff, you've said a number of times that because of the increase in uncertainty at the Federal Reserve, an increase in uncertainty as to the path of their policy, that it makes you less inclined to take risk or on the margins. Which risk in particular looks most vulnerable to you or less attractive as a result of increasing uncertainty on the Fed?
Yeah, and if I could, I want to pair that to my last answer, because that's the directional call, right? So is the Fed easing financial conditions, raising the value of prices, makes risk taking more supportive? Then that's really talking about risk taking in the beta sense, in the directional space. So where are you more vulnerable? Just to your beta exposure to directional rates, beta exposure to your directional equities. But the divergences question earlier about the impact, thinking about globally, that actually makes risk-taking better in the alpha and the cross-sectional space. So it's about portfolio construction, and it's about how much am I putting risk on in terms of directional space. That's really where the Fed today, that you want to be taking down. The flip side is in the alpha space, in the cross-section, it's actually a better environment. That's where you want to be adding risk into the portfolio.
Hey, Jeff, appreciate your time, sir. Jeff Rosenberg of BlackRock. Enjoy the holidays. Remaining of the team will take you through the close in just a moment. Tesla's one to watch going into the close, down 10% at the moment in this session. Have to sort of acknowledge that we're up still about 20-something% this month alone. A couple of things to note here, Lisa. The year so far, Q1, inflation head fake. Q3, labour market head fake. Q4, this Fed looking just a little bit lost.
And honestly, the market is responding to being a little bit lost by selling off in a dramatic fashion.
I'm speechless. I think it's going to be interesting, particularly I'm watching FX into the Japan Open.
Could not agree more. This dollar is a whole lot stronger. Just how much oxygen is left up here? Your equity market's down at session lows with negative 2.9% from New York. Thank you for choosing Bloomberg.